I love it.
Buffering.
Exactly. Hey, everybody. Welcome to the 32nd episode of the Insiders on Real Estate and Marketing. I'm your host, Sandy Hibbard, and my co-host, Mr. Mark Miller, is joining us today, along with our special guest, Mr. Brooks Kelly of the Mortgage Link. So we've got a very timely show scheduled today because mortgage rates are rising and everybody's talking about it. Everybody's kind of freaking out about it. I mean, from homeowners to realtors to investors to small businesses, what is happening? What's going on here? So we brought in the expert to talk about that with us, let us know what's going on, where we're going to go from here, and I'm sure there's going to be lots of great advice for homeowners and realtors who are working with sellers on how to move forward and navigate this very odd market that we're in right now. So, but before we dive into that, a shout out to our sponsor, Secured Title of Texas. We want to send you over to their website, Secured Title of TX. Secured Title is boutique by choice, and they have a team of veteran closers, underwriters, and title staff that are there for you. So check them out. Go visit the website. If you want to experience title the Texas way, check out this guy right here and make that move toward Texas Secured Title. It's crazy. I just got back from Salt Lake City, and there's that, like, it was still hot there.
Yeah.
But there was just that tinge of coolness. It just teased me about
We're going to get
the
there.
fall.
We're going to get there.
Yeah.
Football, college football. I love it this time of the year for that.
Me too.
Oklahoma, Texas game coming up. I always say Oklahoma, Texas. Drives them nuts.
Texas, Oklahoma.
But tickets are only selling at $1,500 a pop for that game.
Really?
That's going to be. I think that's going to be an incredible game to that side.
I haven't paid any attention to football yet this season, and so where are OU and Texas in the rankings? Right now?
Texas is down. They're like 22, something like that. We're ranked number 6.
Oh wow, that's going to be.
But I
interesting
don't.
then.
When you go into that Cotton Bowl on that Saturday, it doesn't matter what your rankings
It
are.
doesn't.
Yeah.
No.
It's the whole atmosphere.
It's an
and everything.
emotional game.
Oh
so
yeah. It's going to be a fun one. So
Yeah.
anyhow.
That's so cool.
Yeah, so market is certainly tilted, as I made reference to last month, and my order count is, as all of us are, our orders are down. Inventories, we're seeing really going into the market, huge amount of inventory. Rates are up, and Brooks is going to talk a little bit about that. So I'm thankful, as I've always stated, that we have the commercial business, because that's really our saving grace, and if you don't have that balance in your business in the title side, then you're going to be having some challenges, and I think we're going to see some companies that are going to be challenged to
So commercial
continue.
and retail and
Retail,
office space is still
well,
growing in
office
this
is
city?
getting a little soft.
Yeah.
Office sales are soft. Retail development is strong. A lot of land sales up in northern Collin County of that side. So we still got some pockets in there that I think are good, but we certainly have our challenges going forward on the residential resale side. So our advice is buy residential real estate.
I like that advice.
Keep it, but it's with everything, and we'll talk about it again with everything that's occurring. It's just they're intentionally put the brakes on, and it's working, which we really don't want. But
It is working. I mean, would we ever have thought just last year that rates would be going over 6?
well, yeah.
I mean, did we think, I mean, as far as someone like me, who's
Yeah.
not in the title and mortgage business, I would, you think you're comfortable and we're going to be at 4 forever.
Yeah.
Or 3, 4, 5, and then here we are, we're, teasing at 7%
Yep.
right now.
Yep.
Yeah.
And I know that he'll be touching on that, but we continue to see a lot of significant changes in the real estate market. So this is a timely show for us to talk about all of this stuff with Brooks, and I'm glad that you could pop over.
Yeah, thanks for having me.
Yeah, Mark, why don't you give us a little background?
Brooks and I have known each other for quite a while now, and I've done business with him. He's an outstanding mortgage loan originator. In fact, he's one of the top in the country, top 1% ranking of loan originators nationwide through Scotsman's Guide, and obviously he's been recognized 7 times as best lender in D Magazine, which is a notation to his strength that he has in his team, and they just have a real compassionate way that they manage and deal with clients, and he's out there in front trying to educate his clients as well. So I'm thrilled to have him here with us. He's a partner in Mortgage Link. The Mortgage Link, I want to hear a little bit about the company, Brooks, to that side. So anyhow, I'm delighted to have him here, and
Me too.
interested to hear what he has to say.
I'm really
Yeah.
interested. I'm in the
Yeah.
middle of buying a house right now. And,
No, are you?
And the mortgage rates have been terrifying us.
Mm-hmm.
I mean, it's like, you hear all the different marketing that's out there. Oh, but look what you'll save and the money that paid based on what you're going to be renting, or oh, in the last 10 years is the average rate. All that is great. It's great marketing fodder. But it really doesn't matter when it comes right down
When
to
it
this is
affects you.
your
What's the mortgage
rate.
payment? Yeah, what's the payment?
And this is what it is today,
Yeah.
this is what it is tomorrow.
Yeah.
Exactly. So let's get
Yeah.
started. Tell us what's going on.
Yeah, sure. Appreciate you guys having me today. It's been a crazy year, like you said at the beginning. We really didn't think that rates would go much past 5% this year. That was the forecast
Exactly.
from the beginning of the year. We knew they were going to go up, but 4.5, 5. That's what we were talking about for several months in the beginning of the year, and they've just kept their foot on the gas pedal, pushing us, faster than we've ever seen before from. Where
Yeah.
we were to where we are today. So
I
it's
mean,
been
that doesn't make
interesting.
sense in my brain, so I want you to
Yeah.
explain that.
Sure.
Why not just raise it a little bit? Why keep raising it? I don't understand that philosophy.
Yeah. So COVID hit, right? March
Right,
2020,
right.
COVID hit. There was a push. Market went crazy for like a couple weeks. Nobody knew. There was no liquidity in the market. And then they figured that the federal government would start buying as many mortgage-backed securities as they could handle. And at first, they started buying too many, which really sent the markets into a spiral. But once they got it right, it started pushing rates down and down and down into the twos, artificially lowering the market, giving free money essentially to everybody in the market.
And everyone's
so-
saying, why didn't I buy a house
Yeah,
then?
yeah.
Yeah, and that's what we were pushing. They're not going to be here forever. You need to buy a house. And typically when something like that happens, it's there for 6 months, 9 months maybe. But they kept them low for too long, really. This should have happened a year ago. They should have started
That's interesting.
September, October last year with this more gradually. And then, we might have seen a slowdown or a slight recession from it instead of just 50, 75 basis point hikes one after another, which is just sent us to a different level in the market from just total craziness in the spring where people were paying way over to get in while the rates were still low and the market just went nuts, to where now, there's price reductions, there's more inventory on the market. It's good for a lot of buyers though, because back in the spring, people that had 3-5% down couldn't buy a house, the first time home buyers. So it's created an opportunity for them if they can still afford to buy, which
Right,
the
right.
interest rates have changed that affordability.
So is it correct to say that the feds played by pulling down the rates and then they played again by bringing them back up? Is
100%.
this the game that they're playing?
100% manipulation of the market, yeah. So it was great in the interim while it was there,
Yeah,
but now
right.
the correction that comes from it is, the supply chain got affected, inflation is, 8-9%, something like that. And so they have to bring that inflation number down, and by slowing the market and slowing, the supply chain, getting, restocking. They still go to the grocery store and still see empty shelves in certain areas, right?
Totally you do. And the prices are crazy.
Mm-hmm.
Prices have gone up. If you go grocery shopping, I go grocery shopping, my family shops every single week because we do family meals all week long. And we cannot believe how, first of all, scarce things are that we've been used to getting. Our Topo Chico is hard to get. And the prices have all gone up, and that's all part of this thing, right?
It's all part of it, yep. So as they bring these rates up, which the federal funds rate everybody thinks that as soon as they raise that, mortgage rates rise. So the federal funds rate that they're talking about is really just an index that they increase as the short-term borrowing rate. So the rate that banks borrow from the federal government, which forever was at 0.25%, it was virtually nothing. So they've raised that 50, 75 basis points to now we're at 3.25%. They forecast that it's going to be in the 4s by early next year, somewhere in the mid 4s. But that doesn't directly correlate to interest rates. It doesn't mean that mortgage rates went up 0.75% 2 days ago. Now they did, they went up about 0.5%, but it wasn't because they raised that rate. It was because the news that came behind it of we're going to do it again, and we're still trying to push the economy towards a recession so that prices of everything else can come down so life can be more affordable, really.
So the federal funds rate is the rate at which money lenders buy their money from the government?
Yes, banks borrow their money from the government. So for short-term things like cars or credit
So
cards,
that's
or
why
things
all
like
that's
that.
gone up.
Yeah, so if you notice all your credit card rates are going up, or if you go to the dealership, you're most likely you're not seeing the 0% or 2% car loans anymore. They're probably 4 or 5% now.
Right, right.
So,
Wow.
yeah.
So how does that have an effect on mortgage rates when those funds go up? Is it just sort of a slow?
It should be. Yeah, it should be. It should be a slow
But it's
deal.
been
But then
Yeah.
occasionally you'll see it arise, and then all of a sudden you'll see an adjustment back down on a very short term
Yes.
basis.
So last time they raised it at 1% instead of, or maybe it was 2 times ago. They said they were going to raise it 0.75%, and they raised it 1%, and rates actually went down for a period of time because the mortgage markets really react to news more than they do the actual. And so mortgages and mortgage-backed securities don't like uncertainty at all. And so they felt like by raising that 1% that the Fed was doing their job and actually getting inflation in order. And so it actually brought the cost of the mortgage-backed securities down a little bit. And rates got better until August 1st. And that's when Fed Chairman Powell said the word pain 8 times in his speech after raising the rates again. And that's since the 1st of August, rates have moved over 1%, probably close to 1.5% in interest rate just since then. So about 50 days ago.
So what do the powers that be intend for this to accomplish by playing this market like this? What,
Well, they're not targeted at the mortgage
Right.
side of it. They're
Right.
targeted at bringing down inflation.
but how
Well,
does that work if
Because-
families are affected?
well, the families are affected because they're going to quit. They're going to spend less. That's what they're banking on.
Yeah, buying less products,
Buying less product.
bringing the
They're
inventory.
trying to- They're literally trying to slow the economy. That's the burn. Is the economy is doing so well, they're trying to slow it. And then out over here, the government's just continuing to just spend like crazy. So we're not really getting an offsetting result. That's why the inflationary from this last time just minuscule.
Yeah, because it's
went
even
down.
affecting investments. So people who have money that would be investing in the stock market are pulling the brakes back a little bit. It seems just
Yeah.
like it's a little topsy-turvy.
Oh, there's no doubt about it.
Yeah,
It's
I mean-
extreme. It's extreme.
Yeah, it is. So what about the global market? I know this is sort of an aside, but does the global market have anything to do with why the feds are doing this?
They're participating in it too, yeah. So part of the sell-off yesterday was because China and Japan, who were the biggest buyers of mortgage-backed securities post-2008 crash, and still continue to do so, started selling off mortgage backs along with the federal government as well. So the reason rates have gone up so much is the feds have said, we're not buying anymore. Well, they said that 6-8 months ago, and they actually finished, I mean, it was a tapering of it, so they finished buying them a couple days ago. Well, at the same time, China and Japan decided they were going to start selling them too, and that's what the big bump was for the last 2 days. So it's, everybody's participating in it. I think China has a significant problem on their hands. They've just been building and building and building. And I think there's a lot of empty inventory there, the Evergrande thing, and there's another company. I think there's some larger global issues that have to be addressed as well. So,
Now, on my side, I've always thought, well, as rates go up, and we talked about this earlier, I'd like your comment on it again, that the alternatives to the 30-year fixed becomes the ARMs, the ARMs. And talk a little bit about what that impact, because that's no longer tied to the LIBOR indexes, which was kind of the common theme, common use to that side. So what's the world of the ARM today?
yeah, it's not as prevalent as it should be. The markets are still trying to find themselves. So that's a product that's a little more exotic. It got a really bad name in 2008 where everybody thought that was going to cause this whole global crash, but it really didn't. Because ARMs are based on an index like LIBOR. Today, most of them are based on SOFR, which follows the federal funds rate. And so all those indexes went down in 2007, 2008. So that
Because when you
wasn't
say
necessarily.
ARM, when someone suggests an ARM, if a mortgage guy suggests an ARM, it just scares you to death. You're like,
Yeah.
oh, no,
yeah.
no.
Yeah, so the rate's supposed to adjust after a certain period, so it's locked in at a lower rate so the bank has less exposure, right? So for 5 years or 7 years, and when that's over, it could adjust. Well, right now, arms would, in this type of market, your arm would adjust to a higher rate.
Right,
Well,
right.
if you get an arm today, most likely it's going to cycle back around. So in 5 or 7 years, the rates probably will be lower. And so as that adjusts, like their rates will probably adjust downward instead of upward. And same thing happened in 08, 09. So,
Right, right.
so it's not a bad thing.
So you think arms are
whatsoever.
okay if it's,
They're okay. They're not hugely available. You'll see them a lot in jumbo products right now. You don't see them in any government loans like FHA and VA. And then in the conforming loan limits under 647, Fannie Mae and Freddie Mac really aren't participating much in that market. So you don't see good pricing on them at all. It's more of a niche portfolio bank kind of product. So it's there, but it's just it's not there like we thought it would be.
Right.
So.
And then what about buy down?
I was gonna ask that same
Yeah,
thing,
are you
yeah.
seeing that?
Yeah,
in
the
contracts?
2-1 buy down's a big thing right
Okay.
now.
Good or bad?
Yeah, it's good.
yeah?
Yeah, it can only be seller funded, so it's in a situation where you've got a listing and it may not sell, and the seller says, well, we'll give you 2% towards your closing costs, and you can use that to do a 2-1 buy down. What that does is it takes, your 6.5 rate down to 4.5 for a year, and then 5.5, and then
So
it's
a step, get a little
6.5.
step up to
Yeah.
it.
So it's sort of
So the
fail
worst
safe,
it could
right?
be is 6.5, right?
Right.
But you get the benefit of the 4.5, 5.5 for the first 2 years. And so ideally, and what Fannie Mae and Freddie Mac are predicting is that rates will cycle. They always do after a recession. So 12 to 18 months from now, we'll see rates lower, and they can obviously refinance it at
So
that
from
point.
what you guys
So-
have seen in both of your careers, what do you think that settling down would be? What do you think it would look like of the rates, the lowering and the settling of the rates?
I think rates were artificially low, right? And they were even prior to COVID, right? They were in the 3s.
Yeah.
4s are
For a
pretty
long
good.
time.
Yeah. I would say the 5s are really a realistic range for where mortgages should be, because what you don't want is the federal government participating in that. You want Fannie and Freddie to come out of conservatorship with the government. And so you want the private market to be buying those securities, and there's got to be a return for them to do that. So 3% rate is just not something we would see unless there's government intervention again.
Wow, that's interesting. So what does all this mean to the homeowner, to the home buyer and moving forward? And we talked about, before the show started, just some advice for homeowners and advice for realtors. What are you experiencing and working in the field with people? What can you tell them and moving forward over this next probably 12 to 18 month period? Well, let's talk about that for a second.
Yeah, I think we're extremely lucky to be in Dallas-Fort Worth. I got here by chance. I met a girl from here and ended up living here. But it's for business purposes. It's a great place to be.
It is. It is.
If you look back to the 80s and the reason for the savings and loan crisis here, it was because the whole Metroplex was based on oil and gas, and that's what crashed. Well, it's a very diverse economy. We have dozens and dozens of Fortune 500 companies here, so we're a bit insulated in what we see here. We were in 08 when this happened too, and so we'll see some price decreases. There's some uncertainty in the market, but in the
So
good
what comes
areas,
up goes up must come down. But
essentially, yeah, it
how,
always does.
how down is that?
But the one thing I think won't go down on the demand side that I think is a benefit to home ownership is rent.
Rent.
The rent side of the equation is just continuing to go.
Well, it's costing the investors more to own it,
Yeah.
right? Their
Yeah.
rates are higher, their taxes are higher, so
When
the
you
rent's not
when
going
you
to come
rent,
down.
You're not writing off anything. You're paying rent.
Yeah.
You guys are buying a property now. You've been
Yeah.
renting.
We've been renting all
Now
this
you're
time.
going to get the benefit of interest rate
Right.
deduction and tax write-off and
Yeah.
appreciation of
It's
your property.
huge.
And depreciation of
Yeah,
it too when you're an
exactly,
investor. Right.
Exactly. So.
Yeah.
And we were able to do that because, just from a very personal level, because of mortgage guys that were willing to go to work for us. So now, I want us to spend some time talking about what you do in working with your clients. And you had mentioned to me what goes up must come down. How do you
Sure.
approach that? And what's the culture
Yes.
at the Brooks Kelly team?
Yeah, it's consultative, like we
Yeah.
work with every buyer to make sure that they're buying what fits them. We're not trying to push them into a certain price home or a certain loan. We look at their goals and what they want to do and where they need their family to be or what investments they want to buy. And we really work with them to get them exactly what they want. So we're not trying to push you into a home this weekend. We want you to be fully educated, knowledgeable, consulted, and worked with the whole process from start to finish. So there's a lot of bad information out there. There's a lot of bait and switch when you look at online lenders and things like that. And having someone local live is very important when you're dealing in a real estate transaction. So.
Oh, absolutely.
Yeah.
So having access to you and your team, does the brand name really matter?
The brand doesn't necessarily matter, no.
You know, we've got the mortgage links, we've got the Fairway.
I don't think it
got-
matters to the consumer. I think it probably, to some degree, it matters a little bit to who Brooks and I serve, which is the realtor
Yeah,
community, just
Yeah.
by being familiar with who we are to that
Yeah.
side. But the consumer is concerned about rate and payment.
Yep.
Oh, that's it.
Exactly.
They're not really focused on, tell me, Brooks, about your company. I need to make sure you're capable of making this loan.
Yeah,
That's not their
they check you out. They
Yeah.
make sure you're legitimate
Right.
and legal, and that you've been in business for more than a few minutes, But
Yeah.
it's more about the originator. Like, you can go to any company and have a bad experience with a bad originator or a good originator. It's just a matter of the person that you're dealing with and how you work with them. So you might meet with a great one and you just don't mesh with them on a personal level, and you might need to find somebody else. So someone that's going to meet your goals and needs throughout the process. So.
I think it's really important for realtors to have established relationships
Absolutely.
with mortgage, because like you said, a homeowner, a home buyer doesn't care about anything but that bottom line. Get me into the house at the lowest payment possible. And if you've got a realtor who is not, and I know that there's probably RESPA laws for this, but you want someone to say, I have worked with this mortgage company, this mortgage lender, and they're trustworthy, they're reliable, they're forensic, like what you're always preaching.
Right.
Or they can not be saying anything, and you'll be pulled in by something that you see online and waste a month's time and wind up not being able to get into the house. So I think that is good advice for a realtor, to have those relationships with mortgage people that you can trust. And then by all means, suggest and recommend, right? I mean, is that okay for them to do that?
Absolutely. Yeah, they do.
Same way we do with title.
Yeah, I mean, they probably take the safe route and say, here's 3 recommendations
Yeah,
to that
yeah,
side.
yeah.
But those that are really headsy into the game, they know who their providers are.
Yeah.
They know who's going to get the deal underwritten, who's going to get it closed, who's going to be in a timely fashion to that.
Yeah.
Who's going to provide a high level of customer service for their client. And that's where they're going to award their business. So, because once they hand it into Brooks' hands, that's a whole world that they really don't understand. So they have to completely rely on Brooks and
Totally.
his team to be able to go through that process and communicate back if there's any kind of challenges associated with underwriting of that file and getting the deal closed to that side. So the fundamentals are still the same of how we block and tackle in the business. And now it's just more responsiveness and being consultative, as Brooks talking about, to kind of bring people's anxieties down and really paint up the picture of the opportunity if you can buy.
Oh, for
It's
sure.
still a good time to buy.
It's always a great time to buy.
Yeah.
It is.
Yeah.
The market could be going down, but trying to find the bottom is like trying to buy a stock at the bottom. It's trying to catch a falling knife, right? So,
If you wait, you're going to wait forever.
Yeah.
Because you're never
Yeah.
going to find
and if
that
you're waiting
perfect
for everyone,
scenario.
then you end up this
Totally.
spring again,
Right.
and you're
Totally
in the market
true.
with
Yeah.
everybody
And
else.
now you go from a lot of available inventory to the cycle tips the other way. All of a sudden, the inventory starts coming back out, and now you're back to the same thing, limited supply.
Exactly.
Yeah.
So I think
Now's
that's-
the time.
Now's the time to jump.
Absolutely.
So,
So capsulize for us as we're winding down the show. Again, what advice can you give realtors and homeowners about where this market's headed over the next year?
Yeah, real estate's all about location, right? So we always preach that, the golden corridor of Preston and the tollway and things like that. Dallas in general is a great place to own real estate. So it's all about the location, right? You'll see some losses in the market as far as home prices go in certain areas, but some areas won't lose any any value whatsoever, and they'll appreciate through this market. So be diligent about your location and where you're going to buy. The good schools, good neighborhoods. Whatever it is that's important to you is important to other people, and so you want to make sure that you're buying in a place that you believe will be a good investment for you.
Right,
So
right.
lean on your real estate agents for that. Like, they know this market. They're the expert in that, and so And from their standpoint, make sure that you're giving the right advice, be the client's ally and not there just to sell another home, make sure that it's a good advice for them. So
Absolutely. That's
Yeah.
good. That's good. Well, we've already ran through our time.
I know it.
Chatterboxes. I know. So let's start with our 3 takeaways. Mark?
Okay. Well, I continue to see, and Facebook's kind of the common medium for the real estate community to communicate out, and I keep saying the same stuff. I just shake my head every time.
Well, because it's not brain science.
Well,
I mean,
they're not putting out the information that's
Yep.
educational.
Yep.
They throw up a graphic of, Halloween's coming up, and where to find your
Happy
best place,
fall.
whatever it is. Or they have something on a statistical side of where listings are, sales are, and there's no commentary
Yeah.
associated with it.
Yeah.
So, I think they need to be more consultative as
Mm-hmm.
well and show their expertise and talk about the market and discuss the positive sides, the sales sides that they're accomplishing versus the other side of it. So I continue to say, communicate strategy
I totally agree with
to
that.
them and not just the statistic side. I always will strongly believe, go local for your lending. And Brooks is an example of that, because they get out in the national sector, they get teased with a little bit of discount or a little bit of lower rate, however that's calculated, but they can't get to the finish line. And there's no relationship there.
Right.
In the local level. And many times it takes the relationship between Brooks' company, my company, the real estate arms, the buyer and seller to get a deal closed. And it's good to have local people that side.
Absolutely.
And, I think to echo what Brooks said is that we're lucky to be in one of the best markets in the country, without question. So don't be afraid to jump in
Yeah.
to the market. If you get the right people and find the right property, the location, schools, et cetera, you're going to have a good investment and you're going to get appreciation from it, because where else are you going to get appreciation right now? You're not going to get in the stock market to that side. Real estate is that return
Yeah,
that
yeah.
you're going to get on your
I love
investment. And so I wholeheartedly believe that's a place that people need to be going, not going feeding the multifamily side at $3 a foot. So those are my thoughts.
That's good.
Yep.
That's good.
Yeah.
So, Brooks, what are your 3 takeaways? What would you like to leave with our listeners today?
Well, I see too often that people try to leave their real estate agent to try to do it themselves, and I think that's a really awful idea.
It's terrible.
And those are the hardest transactions for us because there are no experts in there except for us in the title company, and we're trying to put the pieces together. So trust in your real estate agent. They know the market and they know the contracts and the negotiations. You're going to get a better deal when you use a realtor. Because they're going to negotiate for those items. They know how to negotiate. That's their job. Don't be scared of the market. Get the information, talk to the experts about it, but don't be afraid of it. There's always opportunity. It doesn't matter if it was this spring when it was red hot, or today where things are changing, or 6 months from now when things are where they're at then. It could change on a dime at any moment. You can't sit there and wait, because you're going to be waiting with everybody else, and then you're all going to be back in the market again together. And then we're going to have another frenzy. So educate yourself and find the opportunity is huge.
Yeah.
So,
Good.
yeah.
Well, thank you. That's
Yeah,
good.
thank
That's
you.
good stuff. My 3 takeaways are always going to be a little bit hinged on marketing, but I definitely think that this is a different market that we're in. And not only in the way we market, but with what we market, I think we need to be diversified. So I think for realtors, for mortgage lenders, for title companies, that you need to diversify your market with education, with fun stuff, with market reports, with your listings, with photographs, because we have to remember, whether we like it or not, we are in a social environment now. It's not going away. But to diversify that marketing so that you're hitting all those things and not just focusing on just informational stuff. You could do that on another network, but on Facebook, on Instagram, you're going to have to add a little personalized stuff in there to be able to attract people. But once you attract those people, they have to know what you're about. And that's where that information and teaching and education, I think, becomes real important. So number 1 is, because we're in a different market, diversify your marketing so that you're hitting people on all those different levels. Build trust, number 2, through consistent and diverse methods. So get your message out wherever your audience is. So if they're on TikTok, you're going to have to get on TikTok. If they're on IG, you're going to have to get there. If they're readers, you're going to have to get a blog. So you have to know who your market is, where your customers are hanging out. And that's where your diverse marketing methods have got to be. By being where they're hanging out and giving them a message that's speaking to them is how you build trust. And so that they'll actually approach you about business. And then last thing, can your prospects find you? So again, socials aren't going away. If I have a younger client, they are going to be forensic. They're going to try to find me. They're going to Google me. They're going to go Facebook me. They're going to IG me. They want to see a vibrant profile of who I have represented myself to be. So if I'm representing myself to be a photographer, a marketer, a cool person, then that's what they want to see. If I represent myself to be a realtor, a savvy, smart, local expert, that's what they want to see on my profile. So if people look you up, what will they find? So I think that's very important, is be approachable, be able to be found online, and can they get enough information to make a decision about you? You know, sometimes you see all these links and you go to the links and great, it's all the stuff, but I want to know about him. I want to know about her. Give me the bio. What's her scoop? What's his scoop? What's he about? Who's he worked with? So all these old school marketing things that we've been teaching forever, like have a great headshot, have a great bio, write your feature story. You know, I still preach those things today because the only thing differently we're doing is that we're just chopping them up in smaller pieces and putting them out on more networks.
Yep.
So make sure that your prospects can find you, and make sure that you come back to the Insiders next month in October. I think Mark and I are going to have a really special treat for everybody in October. So go visit the Insiders podcast to get all the scoop on all of our episodes. We're everywhere. We're on Instagram, we're on YouTube, we're on Mark's website on Secured Title, they're on sandyhibbardcreative.com. No reason to have to hunt for us. You'll be able to find us. A special shout out and thank you to our sponsor, Secured Title of Texas, and to our special guest. Thank you so much, Brooks.
Thank you.
For sharing
Appreciate
your
you having me.
expertise. Mark,
Yeah.
love you, buddy.
Love you.
See you next month.
All right.
Ciao, everybody.